Today, I want to talk about how the squeeze is so close. I want to explain how the mainstream media is starting to break down, trying to cover their past accusations. I also want to explain exactly what's going to trigger the AMC squeeze. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, over the last 2 years, we've seen a number of different documentaries about the AMC and GameStop run-up in January of 2021. Although, one documentary I didn't think we'd see is one directly from CNBC. It says here, CNBC's new documentary, Making of the Meme King, explores how Ryan Cohen became the poster child of the meme stock phenomenon and why everyone from Wall Street to Reddit has a different opinion about him. Now, I think there's two different ways that CNBC could go about this documentary. They could either A, vilify Ryan Cohen and explain how much of an evil man he is for trying to bankrupt Wall Street. Or they could praise Ryan Cohen for what a brilliant job he done leading the meme stock movement and trying to crush Wall Street. The thought of CNBC turning against their own and turning against Wall Street just seems a little bit too unusual to me. But let's quickly watch the preview of CNBC's documentary and see which angle they're trying to take.
What he's up to is anybody's guess.
Unmasking the man behind the movement. Making of the Meme King, a CNBC documentary, premieres Tuesday, June 6th, 10 Eastern.
Now, obviously that was a very short preview, but I found this screenshot fairly interesting where they're asking if Ryan Cohen is the angel or the devil. Again, I've got no idea if this documentary is going to be any good, but it would be interesting to see CNBC turning against Wall Street. And another mainstream media outlet that seems to be turning against Wall Street is also The Street. They recently tweeted saying that when failed to delivers reach very high levels, it may be indicative of fraudulent trading behaviour. They then went on to write an entire article about how AMC's FTDs have reached all-time highs, especially over the last few months, and how that likely is indicative of fraudulent trading behaviour. Again, it also talks about the potential for a short squeeze, and it just seems so weird how a mainstream media outlet like The Street is also turning on Wall Street at exactly the same time that CNBC may be doing so as well. And I think the reason why these mainstream media outlets are turning against Wall Street is because the potential for a short squeeze is very real and very close. And that's because AMC short sellers paid $1.9 billion in borrowing fees alone just in Q1 of 2023. It says short sellers in AMC, not for the entire market, not for all meme stocks together, but just for AMC, paid nearly $2 billion in short borrow fees during the first quarter of 2023. I also think it will be really interesting to see just how much they've paid in the second quarter of 2023 as well, when the borrowing rates have been even higher. Considering the market cap for AMC is only $2.4 billion, if the float has been sold 3 or 4 times over, that's only say $6 to $8 billion worth of shares shorted. If they've already paid a quarter of their entire short position just in the first quarter of 2023 in borrowing fees alone, I don't think it will be long until these shorts do end up running out of money. Especially as the article says that AMC's cost to borrow shot up to 1,000% during the start of the second quarter this year. It says that high stock borrow fees can test the conviction level of short sellers, as financing costs can take a large bite out of the expected alpha. Don't forget that's $2 billion of borrowing fees just on those legally shorted shares. That obviously doesn't include the illegally shorted synthetics. Now, I don't know if all those synthetic shares also have to pay borrowing fees as well, but either way, $2 billion is a massive portion of their total legal and illegal short position. Especially because not only have the shorts paid nearly $2 billion in borrow fees in the first quarter of 2023, they also paid $1.5 billion in borrowing fees in the fourth quarter of 2022. So that means they're nearly $3.5 billion in the hole on borrowing fees on AMC, when their total short position is likely only $8 billion, including all of those synthetics. I think all we're really waiting for now is some kind of catalyst to cause these shorts to fail their margin requirements to start triggering those margin calls. This is the Nasdaq chart over the last few years, laid over this very common stock market cycle chart. Since January of 2023, the Nasdaq has been rising significantly again, but that's been carried by just 7 stocks, between Nvidia, Tesla, Apple, Microsoft, Google, and a select few others. The rest of the entire Nasdaq and the rest of the entire S&P 500, bar these 7 stocks, is up only 1% on the year, so is still flat. And therefore it won't be long until this complacency period is exhausted and the stock market crash resumes. It seems like a deal to extend or suspend the debt ceiling is going to be inked over the next few days, but it's still yet to be seen if Fitch or Moody's or Standard & Poor's will decrease the US's credit rating before that deal is secured. And even if that deal is secured, the US still has to print at least $1 trillion in treasury bills at the current high interest rates to restock the US Treasury's cash balance. Whatever does trigger the next leg down in this market crash is going to have a significant impact on AMC and GameStop because it's going to cause tons of these hedge funds to end up going bankrupt. Now, what's also very interesting is that because the AMC squeeze has not happened yet, or because AMC has not yet gone bankrupt, it's putting tons of spanners in the plans of the SEC and the plans of the Fed. As Las Vegas Ape tweeted, he said it's worth repeating, but this whole AMC play should have been over years ago, and AMC was supposed to end with bankruptcy. The shorts were obviously supposed to sell a box AMC, AMC was supposed to go bankrupt and be delisted, but obviously that did not happen. The shorts never thought that apes could make it to the point when the box office would come booming back. Well, we did it. And because AMC has not yet gone bankrupt or the squeeze has not yet squoze, it's throwing tons of spanners in the works of the SEC. As 741 Trey tweeted, he said the SEC extends exemption to the CAT or Consolidated Audit Trail requirements from July 2024 to January 2025. The exemption includes relief from the link between customer orders and representative orders, reprocessing corrected data received after T+5, and reporting of rejected orders. And Bigham just tweeted saying the reason this has been delayed is because it adds a broker ID and a customer ID, and therefore this is the phase they've delayed, because with this they'll know exactly who owns what shares at what brokers, and this will expose synthetics. Now you can't have that, and that's why this ruling has again been delayed. The SEC and the Fed literally cannot improve the stock market until AMC either goes bankrupt or until AMC squeezes. Because by doing so and by improving this disclosure, they would obviously expose those synthetic shares as it gives a broker and a customer ID. And that's why the stock market is effectively stuck in this current loop where there's very, very little volume, and most of the volume that does exist is fake volume created by these high frequency traders. And that's why we're still in this liquidity crisis, why the S&P 500 has not recovered, and why interest rates and inflation have actually continued to rise. And it's likely the S&P 500 will not recover until this is sorted and until AMC either goes bankrupt or more likely squeezes. And considering we're now so close to the squeeze, that's exactly why the street and why CNBC are turning against Wall Street. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.